Thank you and welcome to the Family Office Network's webinar series. Today's event is hosted by Bunkport Capital. Presenting for us today is Greg Bobby, CEO, and Garrett Bobby, CIO. Over the past 25 years, Greg has held a variety of positions within the asset management industry and has an extensive experience in trading, launching and fundraising for hedge funds and corporate finance. At Bunkport Capital, Greg is responsible for corporate oversight, business development, risk management oversight, and investor relations. During the past 22 years, Garrett has held a variety of positions within the asset management industry and has gained extensive experience in the areas of investment research, technical analysis, equity trading, risk management, and portfolio management. He is responsible for strategy development, investment research, and portfolio management for the fund. At the end of today's presentation, we will have time for Q&A. To submit questions, you can do so through the question chat functionality on the right side of your screen. And with that said, Greg and Garrett, I'm gonna let you take it from here.
Great, thank you, Lindsay, and thank you to the Family Office Network for hosting us. And thank you to those attending for taking the time out of your day to participate in the webinar. I'm Greg Bobby, the CEO of Bunkport Capital. We manage a U.S. equity-focused opportunistic hedge fund called the Bunkport Partners Fund. The investment objective is to generate a 25% annual net return with low correlation to the equity markets. We employ a concentrated equity trading strategy focused on capturing momentum while aggressively managing downside risk. We seek to maximize returns when we're right and minimize losses when we're wrong. Avoiding large losses is very critical to our long-term investment success. Every portfolio manager or investor really only attempts to do two things. First is select the best securities to purchase. And the second is try to determine when to dial up or dial down risk exposures. Mastering these two items are essential. And the tools we've created help us successfully navigate them. Our investment strategy is built around three core principles. The first principle is there are times to be invested in the equity market, and there are times to step aside and preserve capital. We utilize an internally developed market directional model to help us determine when it's safe to be invested, when to have caution, and when we should be out of the market or occasionally even short the market. This model is purely quantitative. There's no subjectivity at all, and we'll discuss it in greater detail later in the webinar. The second principle is when invested in the equity market, capturing momentum through a concentrated portfolio of the strongest stocks can generate superior performance. We've found that stocks with the biggest potential to reprice significantly higher share a very specific set of characteristics. We utilize an internally developed quantitative stock screener to limit our investment universe to only the stocks that meet all of our criteria. Typically, the biggest stock gainers are not the usual household names. They're unique businesses where the market doesn't fully understand the potential upside. And the third principle is machines are great for performing analysis and screening for opportunities, but really a portfolio is best managed by an experienced portfolio manager. We believe that no quantitative investment tools should be allowed to operate on their own without human oversight. An experienced portfolio manager should choose only the very best stocks that are recommended by the stock screener. Additionally, entry targets, stop loss levels, exit targets, position sizing are all discretionary decisions made by the portfolio manager. The result from these principles is a concentrated equity portfolio on the long side, with the ability to either go to cash or to hedge with ETFs or even occasionally be outright short when our market directional model is firmly bearish. These three principles also help us generate private equity type of returns in a highly liquid public market vehicle over a full investment cycle. This is a nimble, active strategy, and thus it has limited capacity. We expect to close the fund somewhere between 2 and 300 million, as it's important to remain true to the strategy. I'm going to touch briefly now on the value proposition before I turn it over to Garrett to go through the strategy in more detail. We have two share classes in the Bunkport Partners Fund. There's a standard share class, and there's also what's called a founder share class. The founder share class contains a revenue share. And what that means is those founders class investors receive the portfolio returns plus collectively 10% of the fund's entire management incentive fees. This means as our assets under management grow, the founders class effective fees go down. When we get to our targeted 200 million of assets in the fund, the founders class investors are effectively paying no fees. They're paying a zero management fee and a zero incentive fee because the revenue share they're receiving offsets all the fees they're paying. The founders class is limited to 20 million in total, and there's roughly 8 million still available that is unspoken for. And the purpose of the founders class is to be designed for family offices and high net worth investors who are able to make a commitment investing in the fund more than the stated minimums. I'll now turn it over to Garrett to discuss the strategy in more detail.
Great. Thanks, Greg. So on page 1 of the presentation, a number of these items Greg just discussed, but there are a few that I just wanted to highlight. One being the singular focus. We are firm believers that we should focus our effort on doing one thing really well. So we have this one product, the Bunkport Partners Fund. That is the only product we intend to have. So we won't be branching out from here. The other is the interest alignment, which is very important to us, and that is really a sign of us being all in. As someone who has had a personal trading account since he was 13, I do not have a personal trading account anymore, and no one at our firm does or will ever have one. If we have good ideas, we get them in the fund or we don't participate. Greg spoke a little bit about the capacity, and I'll just give you guys a little bit of a background before we kind of get into some more of the details on the strategy. In terms of myself, I have 22 years of professional trading experience. I'm 44, and as I said, I made my first trade at 13. So I guess I've been a market student of the markets for about 31 years. And one of the things that I realized about a decade ago was that I'd never had a hard time finding good stocks and outperforming during good market periods. But like a lot of investors, I also didn't have a problem giving back a chunk of those profits when the market turned. And this really hit home for me, and it was a realization that I wasn't the only one with this problem. In 2008, when I had left Brown Brothers Harriman, where I started my career and spent the first 9 years, and went to work for a larger hedge fund. And my role is primarily on the research side, as well as generating trade ideas. And when September 2008 hit and the market started imploding, I realized how important risk controls really were in terms of ever being able to really manage money effectively. I also realized that when markets turn, they can turn quickly. And if you don't have a quantitative tool, it's very hard to get out quickly because it takes a while for the fundamentals to really change. And by the time that's obvious, your stock could be down 40%. And so in September of 2008, I went to work, and there are two things I wanted to focus on. One was developing a purely quantitative tool to tell me the condition of the market. Is it bullish, neutral, or bearish? Is it safe to play? Or is there something, a way quantitatively that I can learn to get out of the positions and protect capital that has nothing to do with the fundamentals of the company? The other thing I set out to try and achieve was learning, is there any sort of common pattern between all of my winning trades and the trades that didn't perform up to my expectations? And so I set out to develop these two tools. The market directional model started with the spreadsheet. And really, I'm not a quant, but I came at it from more of a fundamental and observational background. And I really wanted to figure out when a market tops, how does that happen? What are the things that need to happen? Well, you need to have a down day. You need to have a down period. Moving averages need to roll over. A whole bunch of different things that I started testing out. We developed this model 10 years ago. It hasn't been changed in 7 years, and we'll get into more of the detail of that. from the stock portion, what I realized is I plotted every trade I had made personally for 5 years, plotted the buys and the sells on stock charts. And what I realized was that naturally I gravitate toward momentum and I succeed with momentum. So all of the winning trades were ones that were purchased at some sort of high, whether it's a short-term high or an all-time high, and had volume support. And the ones that lost money were ones that I bought on a pullback or were in a trading range. And so a decade ago, more than a decade ago, 12 years ago now, that was the beginning of Bunkport. Developed a stock selection process, purely technical, and developed a market directional model, again, purely quantitative, and put those together. And that was the beginning of all this. So if we look at page 2 here, we can talk a little bit about the investment process. Again, it combines quantitative and discretionary elements. The two tools that we've talked about, the market direction model and the stock selection model, are purely quantitative. There's no subjectivity to them. The discretionary part of the strategy is really the portfolio management decisions. It is, of those stocks that bubble up to the surface, which ones are we going to purchase? How are we going to purchase them? How are we going to size them? Where are we going to manage risk? All of that stuff is purely discretionary. The resulting portfolio tends to be about 10 to 15 stocks. We cap ourselves at 20. We rarely get to that point, but they tend to be 10 to 15 positions, with the top 3 or 4 having outsized allocations. And we're looking for positions with asymmetric return profiles on the long side of the portfolio. As Greg mentioned, we are opportunistic. We don't necessarily short much. We don't do any shorting on the individual stock side. The best hedge for us historically has been getting to cash, but we do have the ability to layer in some shorts. We just don't do it with individual names. We do it with ETFs. And again, the strategy is opportunistic. We can be 100% long. We can be 100% short. We can be 100% in cash. It all depends on the market conditions. Can you go to page 3, Greg? Perfect. So page 3, just a quick overview on risk management. This is the area of the firm where we all spend probably the most amount of time focusing. And risk management for us comes in a lot of different ways. But our philosophy has always been that the good trades take care of themselves. The losing trades never do. And historically, when you look at our numbers, we're right about 42% of the time when we execute trades, which is actually really helpful because we make almost 2 times what we lose on a winning trade. So there's certainly a lot there for us, even being only right 42% of the time. But the nice thing about that is we know going in that 58% of the time, historically, we're going to be wrong on the trade. So when you know that, you take an approach of, I assume I'm going to be wrong. And if I'm going to be wrong, I want to absolutely minimize the risk to the best of my ability. And so there are a lot of different ways we do that. So risk is managed on the portfolio level as well as the individual security level. And part of risk management comes into play before you even come up with a stock. It's built into our stock selection model. So liquidity is a huge risk, and it becomes a bigger risk. It feels like every day in the market, where you think you have liquidity and then all of a sudden the algos step away and there is no liquidity. So one of the ways that we manage risk is just not even allowing ourselves to get involved in those types of situations where we could get trapped. So the stock selection model imposes minimum requirements on price, on market cap, shares outstanding, average daily trading volume, and then what we call average daily dollar volume, which is really the average trading volume times the stock price. And we always want to make sure that we can get in, we can get out. As Greg said, the strategy is very nimble. We like to be able to get the cash in a matter of minutes if necessary. And so we need to know that that underlying liquidity is there for us when we need it, and there's not going to be significant slippage. We also manage risk through portfolio constraints. and we'll get into the details of those, but there are constraints on individual security size, industry size, sector size. One of the most important risk management tools we have is stop loss orders, and we're a huge believer in them. Every position has an actual stop that's in there. A lot of times we're using staggered stops, and the stop is determined before the trade goes on. Position sizing, the way we size positions, is actually driven off of the stop price. So it's all a formula that the stop has to be determined before the position even gets executed, and then upon execution, that stop gets entered. But that's a very valuable tool for us. One thing about stops, though, and I'll say, we have stops in at all times. It's pretty rare that one of our stop loss orders actually gets hit. And that's because we think of stops almost as an insurance policy. Oftentimes, it's pretty clear that that stop is going to get hit, or the trade is not doing what we thought it was going to be doing, or the market conditions just change, and we'll take ourselves out of that trade before that stop gets hit. And that's one of the things we pride ourselves on, is being exceptional small loss takers. We take a lot of small losses, and we try to make our wins a lot bigger than those losses. The ability to hedge the portfolio, that is there. We certainly can and have done that at times. We do it through ETFs. Sometimes we'll do it through option strategies on ETFs or on the VIX. But for the most part, again, the best hedge is to get to cash and just move to the sidelines. And that's a very important point. It's the last point on this page. Capital is preserved by moving to the sidelines during periods of trend transition. We don't have to trade. This fund is structured that way, where we are very happy to move to cash, sit it out, think clearly, take a fresh look at the market. We may go back in a day or two later, but we have no problem getting to cash. Usually it's not for a long period of time. In 2018, there was a longer period of time where we were in cash. And that was in the fourth quarter of 2018. This was the longest period we've been in cash, but we had some concerns about the market in August of 2018. There's a lot of our indicators beneath the surface were telling us that the market was, a little bit dangerous, and that came to fruition on the first or second day of October. This is again where being nimble and having liquidity comes into play. Going into that morning, we were at least 50 or 60% invested. By 10 a.m., we were 100% in cash. We sat in cash until the middle of November. So that was about a 6-week period where we sat in cash, simply because the market was breaking down. The names that we trade, which tend to be high quality momentum growth stocks, were all going in the wrong direction. We weren't interested in any short at that point, and we sat in cash. Our market directional model came back in the middle of November. We put on 3 trades, and we only were able to hold them for about 4 or 5 days before the market directional model again flipped negative. We liquidated those positions and didn't place a trade again until January. So that's the ability that we have. It's what we call sitting out power, and it's there are times when cash is the single best trade out there, and we're not afraid to be in it. If you could skip to the next page, Greg, page 4. So this has a lot of the detail on what it is we do. The left side of the page, which is shaded in blue, those are the quantitative elements of the strategy. The right side of the page are the discretionary elements. And we talked about a lot of this stuff already, but I'll provide a little bit more detail. We get a lot of questions on the market direction model, so I like to try and make that as clear as possible. What this model is a purely quantitative model that is looking at the NYSE composite and the NASDAQ composite. And it's looking at those instead of the S&P or the Russell 2000 or the NASDAQ 100, because we're trying to get a sense of what the overall market is doing and what is the condition of the overall market. Each day, it seems like the NASDAQ 100 and the S&P get more and more concentrated and are driven by fewer and fewer stocks. And while it's important to know what they're doing, it doesn't really tell you what the average stock is doing. And those are the stocks that we tend to be trading. The model is purely technical, And the inputs are what I call widely available market data. And so when I think about widely available market data, I think about information that you could easily find if you bought the Wall Street Journal, opened it up, and look at the summary of the previous day. You could see things on the NYSE and NASDAQ composites, such as the opening price, the high, the low, the close, the volume, the advancers, the decliners, the new highs, the new lows. That's the type of information that we're using. That's what's going into our model. Those are the only inputs. From there, we take those inputs and we've developed 14 different formulas. There's actually only, I guess, about 3 different formulas, but they're used over multiple time frames, ranging from 3 days to 200 days. So we have short-term, intermediate term, and longer-term view of the market. And so we run through these indicators. There's 14 of them. They're equally weighted. And at the end, you get a summary score. And this is very much like a traffic light. In the spreadsheet, it really is. It's red, yellow, or green. And that summary score tells us, is the condition of the market bullish, neutral, or bearish? Now, the market directional model has been battle tested. It's been in use for about 12 years. It's been back tested probably about 45 or 50 years, as much data as we can get. The one thing I'll say about the market directional model is it's never been wrong. And the reason it's never been wrong is it can't really be wrong. It's math. And it's not really predicting anything. It's telling you the condition of the market today. And if you know what the condition of the market is today, and you know what it was yesterday and the day before, you can tell if that condition is strengthening or weakening. And what we do is we pay attention to whether it's strengthening or weakening. Our model tells us that with these colors and the scores, and we take that information, interpret it, and utilize it within our trading. So if it's green, we are bullish. We're looking to be long single name equities, and we're looking to get long the best names in the market. If it's neutral, we start getting cautious. We're going to be extremely selective about putting on a new position. We're most likely taking off positions or at very minimum raising stops. And if it's bearish, we're looking to hedge our positions. We're looking to get to cash. We're aggressively raising stops on something that we may want to hold and give a little bit more time, but we're not executing any new trades. That's the way we utilize the market direction model. The stock selection model is, this is where all of our ideas come from. And we're applying this model to the universe of US equities. We're trading US listed equities, including ADRs, which is about 6,200 stocks. And with the minimum requirements we put on price and liquidity, that drops to about 2,700 stocks. And then we have a number of proprietary filters that we put on that, as Greg said before, they're characteristics that we've seen historically in a number of the best performing stocks. Those are the ones that we want to play with, and those are the ones that we're looking for. So when you filter that down, you're eliminating the majority of the market. And so the actual numbers, historically, we've received about 180 signals per year, which is about 15 per month. So, maybe 3 or 4 signals a week. And this is by intention. We're intentionally trying to make our world very, very small to look for only the best stocks. I've traded with many different people over the years. I've seen many different ways of trading. I've seen people who can look at 25 different names a day and try and capture profits from those. I'm not one of those people. What we can do well is having a small group of names, maybe 1 or 2 a day, spreading that research out, digging into them, and determining if these are stocks that we want to own and fit the profile. So there's not a lot of names, but we dig into them and we focus on the fundamentals as well as the technicals. In terms of portfolio construction, we said a lot of these names that we come across that get through the screener, they're actually eliminated for a variety of reasons. It could be, we don't quite understand the business, or the technicals, the stock just runs away from us, or we're just not interested in it. But ultimately, you get about 10 to 15 positions in the portfolio, and our average holding period is only about 3 weeks, so they tend to get rotated pretty fast, which would make it very hard to build up a big portfolio anyway. In terms of the risk management, we talked a lot about this already, but the one thing I'd point out here is the constraints, where maximum weighting for a sector is 75%, industry group 50%, stock or ETF 25%. So the way to think about that is you can have 75% of the portfolio in tech, 50% could be in semiconductors, and 25% could be in NVIDIA or Intel. Those are numbers that we've never come up against. That's never really been a problem. We're never close to that, but those are constraints that we have in place. Let's go to the next page, Greg. Page 5. So I'm going to try and quickly run through a couple trade examples here, and just to give everyone a feel for what a stock looks like for us. This is an example from a couple of years ago, Accugen, ticker AKAO, which is a biotech company. And on the far left side of the page, you can see the stock moving up about 200% in a day on heavy volume. We don't do a ton with biotech, and when we do, it tends to be pretty small. This was an exception, and it was really because we were able to dig into it. And as generalists, we're not biotech experts or any experts in any industry group, but this made a lot of sense to us. They just released phase 3 data for their candidate plasmamycin, which had expected peak sales of $750 million a year. The entire market cap of this company was only $373 million after moving up 200%. And this is a perfect example of why we do not believe for a second that markets are efficient. After that move, most investors are not that interested in what they call chasing. But for us, we dug into this and said, we think this stock is going to 30. We didn't know how it was going to get to 30. Normally, we'd be a little bit more patient with the purchase and try to buy it a little bit after that pullback and starts making that move. But in a case like this, we've also seen many times the stock go to 30 in a matter of days as it fully does get priced in. So we put on the position, we put in a stop, and you can see that, the protective stop in the dotted line. And as the position started working, it would have natural pullbacks, break out again, and we were raising the stops along the way. When you see in the boxes, you see number 3, that's where we took off the first 55% of the position after that move. And the reason for that was twofold. One, if you look at the chart closely, you can see a number of lower wicks on the candles here. And watching this stock in real time, what we saw was distribution. We saw a lot of selling and then coming back toward the end of the day, but still didn't feel all that comfortable with the distribution, as well as event risk rapidly approaching with an upcoming earnings announcement. So we took off a little bit more than half of the position. Going into earnings, we raised the stop aggressively. We don't take a lot of event risk. This was one of the few times we did. The reason we did was it was a biotech company with no revenue, no earnings, so it wasn't really possible for them to miss on revenue or earnings. It was really just going to be an update on FDA meetings. So we did take the earnings risk on this stock. It gapped down. We were stopped out at the open, and it was held for 91 days, and the return was 61%. Next page, Greg. Next page is iRobot. This is an example of a losing trade. We all know iRobot. They make the Roomba vacuum cleaners. It was a stock that we had traded multiple times in the past. Again, this one also came on an event. We get a lot of our ideas from events, and they had strong earnings, but more importantly, they discussed a change in their business model where they're going to be becoming more of a tech company focused on machine learning and data collection. We like the story. We like the stock. We like the setup. We waited a little bit on this one. We thought it was a little bit extended. I guess about 10 days after the signal, we started putting on a position. We didn't get the whole position on. It hadn't broken out again, but we did put some of it on, and it quickly started coming in. It didn't hit our stop, and we were willing to give it a little bit more room simply because it didn't hit our stop and we were still building a position. It started coming back, and then the market overall started weakening, and you can see that up the last arrow in box 3, where our market directional model went from bullish to bearish overnight. It didn't even go to neutral. And from there, it was a very easy decision. We had a stock that we were down 2% on, and the market condition went from green to red. We exited the stock immediately. It would have hit our stop 2 days later had we not done that. So this is again being proactive on our stops, and the trade pretty much imploded after that, but we got out with a 2% loss. Next page, Greg. Next page is the monthly returns for our fund as well as for the S&P 500. And there are a couple things I would point out on our returns. One of them is that if there's something we're guilty of, it's certainly lumpy returns. As a concentrated manager, a lot of our returns come from our best 3 to 5 stocks in any given year. We never know when those trades are going to come, so there's certain lumpiness in the returns. The other thing that I would point out here is that there's really no drawdowns across the board in these monthly returns. And in March, we're going to have a 5-year track record. And the only time you see any drawdown in this history is between September and December of 2016. And there is a very specific reason for that, which is footnoted a few pages from now, but I'll give you the quick story. Before launching Bunkport with Greg, I was director of research at a large Raymond James office in Rhode Island. It's the 5th largest in the country for Raymond James. And I was also running the strategy on the side for myself, for personal money. And in September of 2016, the compliance officer and the CEO of the firm had a discussion with me. They're concerned about my trading activity, and I was given a lot of restrictions. I was able to continue operating with restrictions because I wasn't willing to just not be able to trade. But those restrictions were basically a 30-day holding period and very limited activity. Well, those don't work very well when you run a very concentrated portfolio of momentum growth stocks. So what you see in September, October, November, and December is a result of me running the strategy the exact same way it had been run previously and is still run today, but without the most important tools, which were risk management. In the middle of December, I went back to the CEO of the firm and said, look, I tried it your way. This is the results. I'm losing a lot of money here. And let me show you exactly what my process is, how I trade, how I go about this, and let's continue the conversation. Walked him through every detail of my strategy, and he said, Garrett, when I saw your confirmations, I didn't understand what you were doing. I still don't completely understand what you're doing, but it makes a lot more sense to me. So you can go back to doing it the way you're doing it in the past. And by the way, I'd like you to start managing my IRA for me. So that's the drawdown. It was the only time. It doesn't make any sense whatsoever when you think about the way we run money and how much we focus on risk management. But unfortunately, it's part of the track record because our risk tools were taken away from us for a 4-month period of time. Besides that, you have some outsized returns. You have some large years. You have some smaller years. All years are positive. And there's a bunch of lumpy months. I think 2018 is probably the most representative year of what we do and what we're capable of, simply because we had a couple different periods that year. In Q1, we had what used to be known as a normal correction, which is 10 to 12%, which we completely sidestepped because of our market directional model and actually showed positive results in Q1. And then in very beginning of October through December in 2018, you can see our returns of down 40 bips, up 72 bips, and up 6 bips. And that's the period of time I was talking about before, where we went from heavily invested to completely in cash in a matter of 30 minutes and only made a couple trades for the rest of the year. And all these returns are net of fees. Greg, can you go to the next page? Try and run through this quickly. Page 8 is a graph of our equity curve. You can see the drawdown in the very beginning, which we just discussed. There's one really important part of this equity curve, and it's intentional. It's not by accident. Our philosophy is that we should try and keep our equity curve as close to all-time highs as possible. So when the market rolls over, if we can keep it as close to highs, then when the market conditions eventually improve, while everyone else is digging themselves out of a drawdown, we're going to be able to quickly move to all-time highs once again. We'll be in a position of strength. That's completely intentional, and that's why you see a chart that stair steps. We go sideways, we take a leg higher, sideways, leg higher, but there aren't any major legs lower. It's because of the philosophy. Next page, Greg, 9. This is just very simple trailing period returns. Everything's net of fees. The top part of the page is annualized numbers. The bottom part of the page is cumulative numbers. Again, this information is all audited and verified. You can see over the last 4 years and since inception, we have exceeded our goal of 25% net of fee return over a full market cycle, and we'll have a 5-year number at the end of March. Page 10, Greg. So this is the page that gets me the most excited. This is a page that I think as a firm we're all most proud of. And I'll walk you through this because it is a little bit different than what you've probably seen elsewhere. But what this is a chart of every month since our inception, which is 55 months, where the S&P 500 lost 2% or more during a single month. So since inception, there have been 9 times where the S&P lost 2% or more. And so where do I get that 2% number? It's not data fitting, it's an important number. Beyond 2%, the S&P 500 or any market tends to cascade lower. Within 2%, it tends to be noise, and the market might be up at 1.5% or down 1.5% a month. But beyond 2% threshold, you tend to have some serious pullbacks. That's what we've seen over the 55 months. What you can see by looking at this chart are 2 things. One, we have outperformed all 9 times significantly. We have had 2 months where we were actually positive, February 2018 and December 2018. The other months we were negative, but we lost a lot less than the market. And on the far right side of this page, you can see the average. The average, and this goes to what I was just saying about the markets cascading lower. When the market, the S&P 500, drops 2% in a month, on average, it drops 6.2%. That's over the last 55 months. Our average return over those 9 months is negative 0.3%. And that is net of fees. This is what we're most proud of. This is what we're trying to do. This is how we keep our equity curve close to all-time highs at all times. It's really managing that downside aggressively. And being able to get to cash plays a huge role in this. Next page, Craig. And just sum it up with the last couple pages here. I'm not going to run through all this information, but the left side of the page you can see is Bunkport Partners LP versus the S&P 500, various statistics, the number of months, positive, negative, average returns. In the middle of that section, you'll see 2 drawdowns, and the first one, maximum drawdown 2017 through 2020. That is the period that we feel is representative. That is our maximum drawdown has been 4.06% versus the S&P, which had a drawdown of nearly 36%. The next drawdown below that is just for 2016. You can see the drawdown that we had, but again, that was without our risk controls. So we just separate them because I think it's important. There are 2 different time periods here. Below that, you see the correlation to the S&P 500 index. This is what has a lot of people excited about Bunkport. It is a correlation of 0.15%. The ability to post completely uncorrelated returns to the overall market is something that is obviously can add a lot of value within the context of an overall portfolio. Then we have the Sharpe, the Sortino, downside deviation, stuff along those lines. On the right side of the page, you just have some Bunkport specific information. There's no way to compare this to an index because it's just for the fund. But you can see, as I said, our average holding period is pretty small. The winning trade is only 19 days, less for a losing trade. And you can see our winning percentage at the bottom there is, like I said, about 42%. However, we're close to 2-to-1, and that's our goal, getting 2-to-1 wins versus losses. And that's where the money gets made. Next page, Greg. Page 12, this is just basic information, but the one thing I'd point out here is just very friendly liquidity terms for our investors. Philosophy has always been if we have liquidity to go from 100% invested to 100% cash in 15 minutes, why is it that we wouldn't be able to provide monthly liquidity to our investors? It doesn't make a whole lot of sense. So we are committed to doing that. People can come in, come out as they see fit with very limited notice. And then, Greg, I'm not sure if there's anything beyond that. It's really just the bios of the team. It's Greg and myself. We have one other member of our team. His name is McKinley Slade. McKinley has been working side by side with me for nearly 4 years. He's been an instrumental part of this track record. Does a great job with generating trade ideas, implementing trades, and splitting the research with me 50-50. So he's the third member of the team, and that's pretty much all I had. So Greg, unless there's anything else you wanted to add to all that, anything I may have forgotten, we could probably open it up to questions.
Nope. The one thing I'll add is for all of the statistics we showed, that was for the standard class, which is the full fees. The founders class investors would have done better. And Lindsay, we're ready to open up to some questions.
Gentlemen, thank you so much. Yes, so to all of our attendees, just a quick reminder to chat over those questions using your questions drop-down option on your screen. Gentlemen, I'm going to jump right into it here. I believe this question came through around slide 5. It's asking the average gain per position or average gain per day held. Does that make sense?
I don't. Greg, can you fast forward to slide 5? I'm trying to.
Of course.
I'm not sure what that's referring to.
It might have something to do more with this slide here.
Yeah, I'm not sure exactly. The average trade return, if that's what we're talking about, of 1.13%, that is not per day, that is per position. And it may seem low, but that's because we do a lot of trades that are, we get paper cut losses out and they sort of add up. So there are times where we may put on a position in the same name 3 times, and the first 2 times take a 1% loss, and a third time make a 30% gain. And so that's really going to impact those averages.
Okay.
I'm not sure.
No problem. Let's see. Moving on. Next question. What size of total capital did you start with back in 2016, 2017?
Yeah, the capital has really evolved over time. It was very small, around $100,000 when it got started, and then that was originally just a separate account, a part of my capital that I allocated I opened up a new account with a fresh amount of capital to just get a very clean track record. And then it expanded to other accounts, it expanded to my boss's account, it expanded to Greg's account, some other friends and family. So it really evolved to the point where it's now approaching 20 million.
Fantastic, thank you. And kind of adding on to that, I guess, how much total capital are you managing now? I guess it would be the 20 million.
20 million.
Okay.
Yes,
just
we
don't
have,
want to miss anything.
And just to clarify that, we do have a $5 million separate account that is part of this. So that's included in that total. That came on in, I guess, June or July of 2020.
Perfect. Thanks so much, Garrett. Next question. What aspects of your strategy incorporates private equity strategies, as nothing that you have discussed seems to be private equity-like?
I'll take that one. There's nothing within the strategy that trades in private equity or traffics in private equity. Our point is we generate private equity type of returns in a public equity liquidity type of vehicle. So what that means is larger returns. They can be lumpy returns, but returns that can be very significant, where the public equity markets may tend to generate lower returns a year, and private equity tends to return much higher percentages. That was the point on that. But everything we are investing in is extremely liquid.
Great, thank you so much.
It's more about the return profile. Is what we were talking about.
Great. Let's see, next question. From a tax perspective, would you say this is better suited for an IRA?
Yes, it certainly, it's not a strategy that is extremely tax efficient. So we found investors, yes, like to put it in IRAs. We've had some investors combine this in conjunction with some of those other unique tax strategies, such as investing in air rights and such, where they get heavy tax incentives. And we've also had a fair amount of real estate investors use this as their equity market component, and they didn't necessarily mind the lack of tax efficiency in this because they had so much tax efficiency in their real estate developments.
Thanks, Greg. Next question. Energy stocks with unrelated business income, do you invest into them?
Not that I can recall. We've done the answer is no. It's not something that we've ever looked into investing. For us, our stocks really come from our stock selection model. And just, I can kind of talk about that a little bit. Most of our stock ideas these days tend to be focused on technology, healthcare, and consumer discretionary. That's where a lot of the large, or the best growth momentum names are coming from. The nice thing about the stock selection model is it naturally evolves with whatever is sort of working in the market. So back in 2007, we were getting more industrials and materials and maybe some energy names as well. But no, that's not something we're necessarily looking into. We would invest in energy stocks if they showed up on our model, but I think most of them are pretty far from showing up at this point.
Great, thank you. And I think kind of adding on to that, if you can elaborate a little bit more on what kind of stocks you are buying, and are you just buying concentrated positions in Apple and Microsoft like many of the mega-sized hedge funds do?
No.
It's a great question. Go ahead, Garrett.
I was just going to say, no, we tend to, and I'll let Greg add to this in terms of those large companies, but we tend to favor mid-cap companies. I think the sweet spot for us is sort of that 5 billion, 20 billion. So it's definitely not those FANG names, if you will. And we're certainly not just going in and buying them. It's very careful in terms of the technical setup, the fundamental setup. One of the larger names that we've owned on and off a number of times this year has been Square. That's on the high end, especially now in terms of market cap. That's approaching 100 billion. But yeah, the best returns for us have always come in that sort of $5 to $20 billion range.
And historically, our performance has been built without any of the FANG names in it. We haven't traded the Apples or the Microsofts. We tend to focus more on the companies that can have the potential to become the next Apple or Microsoft.
Fantastic, thank you. All right, moving on. It seems like the frequency of large sell-offs in the equity markets has increased. Also, the sell-off seems to be larger than they were in the past. Why do you think this is?
It's actually another very good question. And what has really changed over the last at least 5 years and maybe closer to 10 years is the plumbing of the markets. When Garrett and I both started in the industry, there were large firms that were market makers, and individuals were responsible for the liquidity in equities. Today, algorithms make up about 80% of the market making liquidity, according to JP Morgan. And those algorithms are trained to step away or make smaller markets or not make markets at all when volatility rises. So what happens is the market has a lot less depth at the very time it's needed. So from there, when large positions need to be sold, or simply when there's large demands for hedging, you get magnified moves to the downside. And that's what happened in October through December 2018. That's again what happened in February and March 2020. These seemingly 100-year floods are coming once a year, and it's very much due to the algorithmic nature of market making. The other thing that's causing a bit of this is the increased risk to passive investing. The view used to be, well, just buy the S&P 500. It's a large diversified index. And that's changed a lot. Right now, the top 6 names in the S&P 500 are almost 25% of the index. And the top 10 names are a bigger component in the index than the bottom 350 combined. So what that means is when you're trading the S&P or the NASDAQ 100, you have a very concentrated portfolio of the largest names. And when they're not working, you have a significant amount of risk. So these dynamics tell us it's even more important now than ever to be tactical and be able to step aside of the large falls.
Great, thanks, Greg. Next question, what do you believe is your edge or competitive advantage versus other equity hedge funds?
I think we have a few, the edge comes from a few different components. Obviously the market directional model and the stock screening process, because both of those are internally generated tools. No one else has them. We didn't purchase them from anywhere. We've never shared them with anyone. So that's certainly an edge. Another edge is behavioral finance. And for 100 years, investors have behaved the same way. They tend to cut their winners short and they tend to hold on to their losers too long. They tend to overreact to bad news and underreact to good news. We're taking advantage of these sort of behavioral finance tendencies all the time. And lastly, I would say the ability to step aside and go to cash when the market's under pressure is definitely an edge.
Thank you. Let's see. You stated that you have no correlation to the overall markets. Why is there no correlation? And how are you that different from the overall equity market, yet you only trade stocks?
The correlation that we talked about in the presentation, the 0.15, that comes from a few different reasons. One, it's because we have a concentrated portfolio in the names that aren't the biggest names in the index. And as we just talked about, the S&P 500 is the top 6 names are 25%. If we're not in those names, we're not going to have a very high correlation. So that's certainly where some of it comes from. And the other part, obviously, is the ability to go to cash. So we don't have a correlation at all when we're holding steady and the market's falling like it did in February and March, down 35%. It's also a unique factor to our fund where we found a fair amount of investors like having an allocation of Bunkport as a complement to any passive equity longs that they have.
Great, thank you. Next question, did I hear you say that 12 million of the founder's capital is still open to subscription? And what is the minimum holding period for such investments?
There is a roughly 8 million available of the founders. The founders is limited to 20 million in total, and there's roughly 8 million of it available. We have a full term sheet on that. So if anyone attending the webinar wants to see the full details on that, on the minimum sizes and the structure around it, we're happy to share it with them. Just reach out to us or reach out to Lindsay and she'll get you in contact with us.
Perfect, great. Next question, do you only buy stocks or do you use options as well?
We do both. And whenever we look at a trade, we'll look at it in both instruments. There are times we might choose to use an option instead of a stock, and there are times we might choose to use an option strategy in addition to it, buying a stock outright. We might find a stock we really like, and it just tends to have higher volatility and gappier type moves. And we're just not real confident that if we set the stop where we know we need to set it, it's not going to get triggered relatively quickly. We want a little bit stronger ability to hold it. We may purchase a call or a call spread limiting our downside risk to the premium. So it gives us a little bit, gives us a chance to give it a little bit more room, if you will, to bounce around. There are other times where we find a stock and we really, really like it, and it's becoming a bigger component of the portfolio, and we may put some of the position in the stock, and we may also put some of the position in options. And what we're really trying to do there is just make it as asymmetric as possible to the upside. But the one thing about options with us is we're never net sellers of options. So all of the option trades we do have a defined risk component to them.
Great, thank you. And it looks like we probably have time for maybe one more question, but if we didn't get to any of your questions, we will be following up with everyone individually to make sure that we can answer those. Last question, can you elaborate on how your founders class revenue share works? And is that available to any investors? I'm sure you touched on this already.
We touched on this a little bit, but we'll go into it a little bit further. It's sort of interesting how we did it. A revenue share is not a new concept. We didn't create it. A lot of hedge funds offer revenue shares. The standard revenue share, however, tends to have a time limit of 5 to 7 years, and then it just ends. And that didn't make a lot of sense to us, because why would we want to encourage our best investors or our largest investors, if you will, to then go find another revenue share deal or sweetheart deal or whatever you want to call it after that time horizon ends? We'd rather have them stick with us and grow with us and get rewarded for being that larger investor. So we chose instead to not have an expiration on the revenue share, and founders class investors continue to receive the revenue share as long as they leave their initial investment in. They're welcome to take out profits even on a monthly basis if they like, and as long as that initial investment remains in place, they'll keep getting it.
Perfect. Thank you, Greg. We are running out of time, gentlemen. So if there's anything that you would like to add before we sign off, now would be the time.
Nothing for me to add. Garrett, do you have anything?
No, just thank you very much for everyone who took the time to attend this webinar. We really appreciate it.
Yes, thank you. And to all of our attendees, as I mentioned earlier, we will be following up with all of you individually. So if there's any other questions, I will get you in direct contact with Garrett or Greg. We thank you so much, and we hope you have a great day.
Great. Thank you.
Thanks.